When one of the greatest investors in history starts buying your investment, you start to pay attention. And today, I want to talk to you about one of the greatest investors of our lifetime, one of the most famous investors of our lifetime, and how he's buying a stock that's in my portfolio. Today, we're going to be talking about Bill Ackman and Brookfield. Now, if you don't know who Bill Ackman is, I strongly suggest you check him out. He is the guy when it comes to some of these like deep value plays. He has some really insightful thoughts. He does a really good job of sharing and talking. He's not quite a Warren Buffett type, but he's just about that next level of super investor, where maybe he's not the greatest of all time, but he is on the list, up there with the Ray Dalios of the world, these really famous, really respected names. And one of the stocks he has been loading up on over the last year is Brookfield. I mean, look at the chart right here. You see the ownership history of Brookfield in his portfolio at Pershing Square Capital, which is his big hedge fund, has increased all the way to 18% as of Q1 2025. That is a huge chunk of his portfolio. And so today, we're going to talk about Brookfield and what has made it such a solid capital compounder and why I think it is being undervalued by international investors who should really get a piece of this. Welcome to Golden Arch Investing. My name is Liam. Here on the channel, we talk about investing in Canada. If that interests you at all, please do like the video, subscribe to the channel. Today, to help me illustrate my thoughts, I'm going to go through one of my favorite articles talking about Brookfield. It's on Seeking Alpha. We often cover articles here. I always want to recommend you guys check out the author. If you pay for Seeking Alpha Premium, if you can give them a click, please do. Title of our article today, Brookfield Corp, extremely undervalued and largely ignored by U.S. institutional investors. So this article is claiming that it's undervalued, it's trading at a big discount to the sum of its parts, and that big investors seem to be ignoring this. Now, obviously, we know one who isn't, Bill Ackman, and this is exactly the kind of play you'd expect that guy to be in on. Something where he sees real systemic undervaluation and he thinks he can get ahead of the trend. BN's primary asset is its 73% ownership in Brookfield Asset Management, high-quality capital-light business with strong growth prospects. Brookfield's wealth solutions and carried interest are poised to drive substantial future cash flows, and BN's diversified cash flow sources and strategic investments positioned it to create 25% plus compound returns for shareholders with further upside potential. Now, obviously, they're rating this a buy. We're talking about BN stock. It can be complicated. I know Brookfield's in the news for all the political reasons, but if you're looking at Brookfield from an investment perspective, it can be complicated because you're going to look up the word Brookfield and you're going to see all these different stocks. BN is Brookfield Corporation. It's the stock that Bill Ackman is loading up on. It's the stock that I own, and a lot of the sort of board of directors, the big guys that Brookfield own. Not to say that you should copy the board of directors' moves or that necessarily makes it the best option out of them, but it's one that I own, and honestly, it's one we've talked about here on the channel a good amount because it owns chunks of all the other Brookfield businesses, and so it gives you exposure to basically everything they do. Now, as they point out here, Brookfield is a high-quality, asset-rich, rapidly growing business with a superb management team that has a long-term track record of excellent capital allocation. And that's absolutely true. Brookfield is super strong in the world of capital compounders. We talked about this recently when talking about RBC and some of the reasons why investors love that. Because slight outperformance year on year on year turns into gigantic outperformance in the long term. As a long-term investor, somebody who wants to own these stocks for the foreseeable future, seeing strong management, seeing a diversified business model, seeing strong capital compounding, great return on invested capital is essential. And Brookfield has done that year on year on year. We met and worked alongside Bruce Flatt, Brookfield's CEO, in 2010 on our investment in General Growth Properties, the most successful equity investment in the history of Pershing Square. Bruce and his team have done a remarkable job building Brookfield into one of the world's largest and most profitable and alternative investment managers since that time. This is coming from Bill Ackman, I should say. We initiated a position in Brookfield in early 2024 as we believed BN stock was extremely undervalued. We acquired our interest at 11 times distributable earnings, a measure of recurring economic earnings which excludes certain non-cash and other items. Our acquisition at this valuation was made possible in part due to the complexity of BN's holding company structure, with which owns economic interest in a handful of interrelated businesses and contractual cash flow streams. Brookfield Corporation is a Canadian multinational with a 100-plus year history as an owner-operator of critical infrastructure and assets, which power the backbone of the global company. Brookfield's principal asset, which comprises 2/3 of BN's value, is its 73% ownership of its $76 billion market cap publicly traded asset manager, Brookfield Asset Management, BAM. Their other major interests include preferred claim on BAM's carried interest, 11 billion of capital invested in BAM's private funds, 15 billion in equity ownership in Brookfield's publicly listed affiliate companies, $25 billion real estate investment portfolio, and a rapidly growing wealth and retirement solutions business, which specializes in long-dated annuities. While BN's corporate structure is complex, understatement, BAM is a simple, predictable, high-quality, capital-light business, all attributes of a classic Pershing Square investment. In light of BN's complexity, we herewith provide a deep dive into each of its principal business units and assets, which is not required reading, but one that is useful if you'd like to learn more. So let's start here with BAM, the asset management subsidiary, which remember, owning BN gives you a big chunk of. So yeah, you can own them outright, but you can also own BN and have a diversified portfolio that also owns the biggest chunk of this. This is from 1997. BAM was one of the world's preeminent alternative asset managers, 540 billion in fee-paying assets under management, deep expertise in infrastructure, power, renewables, real estate, and credit. BAM generates free revenue from the management of Brookfield's affiliated entities and 370 billion of rapidly growing third-party capital. Megatrends propelling BAM's business include decarbonization, digitization, and deglobalization, which has driven global investment in clean energy and transition, critical infrastructure, and artificial intelligence. Brookfield's long history as an owner-operator of real estate, with large and varied sources of principal and third-party capital, robust co-investment capabilities, and vertically integrated operating companies make BN a unique partner of choice for some of the world's largest investors and corporate counterparties in these sectors. What this is saying in fancy words, they own a huge amount of incredibly profitable cash-flowing assets. And because they're talking alternative asset managers, this can be anything from a bridge to a pipeline, it can be anything from an office building to a parkade. It can be basically anything that the team at BAM, as part of Brookfield, think is really valuable, provides good free cash flow, it's a good return on invested capital. And of course, a lot of the big trends include things like, big buzzwords, decarbonization, digitization, but also deglobalization. Think about the massive amount of spending in places like infrastructure in the US and Canada. Think about defense in Europe, Canada, the US. Think about energy security across the Western world. All of these places require huge amounts of capital. BAM's going to benefit from that too. Trillions of dollars of infrastructure development are necessary to effectuate the potential of artificial intelligence in the areas of energy transition, power and utilities, and digital infrastructure. Brookfield is the largest global owner and builder of renewables and data centers. BN's existing assets, sector-specific investment capabilities, and access to capital make it uniquely positioned to meet these AI-driven demands. Brookfield's investment in AI infrastructure provides technologically agnostic exposure to growth in AI. So they don't care who wins AI. They just care that there is demand for compute in general, and they will benefit either way. And honestly, it's kind of like owning the picks and shovels guy, right? Think about the gold rush metaphor that everybody's used since AI has been a thing, right? Yeah, you could be a prospector, sure, or you could be the guy back at camp selling pickaxes, selling shovels, and you make an awful lot more money in the long run if you're the guy selling shovels. That's what Brookfield's trying to do here. That's what Bill Ackman's saying, hey, pay attention to. Let's see. Brookfield's investments in AI infrastructure provide technologically agnostic exposure to growth in AI and generates royalties for BAM in the form of management and incentive fees from the backbone of future AI infrastructure investment. In 2024, BAM generated 4.3 billion in fee revenues, principally in the form of management fees from long-dated or perpetual capital. Holy, just about $4.7 billion in fees, 2.5 billion of fee-related earnings. We anticipate BAM's fee earnings will roughly double through 2029. They're talking over $10 billion in fees. Holy, as BAM rapidly scales its fee-paying assets under management on a growth path to more than $1 trillion. BAM's margins are poised to expand as the company has bolstered its investment and organizational capabilities in recent years. To highlight the value of BAM in BN, so remember, the asset manager, which is its own thing, inside of Brookfield, which is what we're talking about today as a whole, Brookfield spun out a 25% minority interest in the company. In recognition of BAM's high-quality asset light and rapidly growing fee earnings, market currently values BAM at 28 times earnings. $56 billion asset for BN, reflecting its 73% proportionate economic ownership. Standalone BAM listing has had the effect of highlighting just how cheap the rest of Brookfield is. And I think this is super cool, because think about that for a second. This is something we saw recently in other industries. We talk a lot about oil here on the channel. We really do like talking about the Canadian oil industry because there's like huge opportunity there. But recently we saw how just one company suddenly being bought, or at least being, having a proposal to be bought for the value of its assets, highlighted how a lot of big companies, including Brookfield here, might have their sort of real value hidden away. Now, market inefficiency is not a common thing, but often, if you're going to find it, it's going to be in a big, complicated multinational like Brookfield. Carried interest. BAM's public market valuation includes minimal credit for carried interest, the promote or profit sharing from the funds it manages. BN retained a disproportionate share of BAM's carried interest when it spun out a minority interest in BAM to shareholders, including 100% of carried interest from funds was existed prior to 2023, and a 1/3 claim on carried interest on all BAM funds thereafter. We believe Brookfield is poised to realize accelerated growth and carried interest over the medium term as select vintages of BAM's flagship funds enter key monetization windows. As of the latest quarter, BN has accrued net unrealized carried interest of $7 billion attributable to the corporation. Management estimates the company will generate more than $10 billion in net cash flows from carried interest over the next 5 years, more than $20 billion in the next 10 years. Leave BN's carried interest asset receives minimal credit in its current valuation, as BN's current earnings include minimal contributions from carried interest due to a lack of realization transactions in the funds it managed in recent years. Exactly what we're talking about, right? The market doesn't see this. It's not there on a quarterly basis. If you dig into it the way that, again, super investor Bill Ackman here digs into it, you understand the valuation. But then if you just look at the quarterly earnings, you don't see that there's $20 billion coming in basically pure profit that isn't on the balance sheet. That's crazy. We anticipate a substantial increase in cash flows from carried interest over the medium term should increase recognition of this important asset. Because once you see the actual interest get paid out fully, all of a sudden that goes into the cash flows, that goes into the valuation. And then you notice, whoa, they own all this. They're going to continue to make interest like this. So if we want to keep the PE at the same kind of ratios, we got to move the price. Really interesting. Publicly traded affiliates. This is honestly where we, as a channel, as a community here, got into Brookfield. Because we were first talking about, okay, like renewables, if we're trying to sort of hedge our portfolio, which is pretty focused on energy, right? Okay, well, renewables. Well, obviously Brookfield's renewable business was really popular. But then a lot of really, really smart people came on the channel and were talking to me about, hey, why wouldn't you just own the parent? And this is where Bill Ackman's getting into here. They generate stable and growing earnings from distributions related to $15 billion of units it owns in multiple Brookfield affiliated publicly listed entities, including Brookfield Infrastructure and Brookfield Renewables. These affiliate companies invest their balance sheet capital alongside BAM's limited partners and generate predictable and growing high-quality cash flows. These funds investments typically feature long-term contracted cash flows and inflation indexation. BN's listed companies have compounded funds from operations, measure of cash flows at 10% or more over time, and are unique and synergistic to BAM, as they provide a perpetual capital partner with vertically integrated global operating capabilities. They are also managed by BAM, generating perpetual management fees and pay stable growing distributions to unit holders, of which BN, Brookfield, the parent, is the largest owner. So again, this is a big part of why you want to own the whole company. Because yeah, the asset management business is great. But wouldn't you love the infrastructure business? Think about a business that has huge tailwinds right now. Infrastructure. And then renewables. Okay, maybe not renewables moment right this minute. If you're thinking 1-2 years, yeah, renewables might not be the place. But 5 years? 10 years? 15 years? Now we're talking about wanting some renewables exposure. I mean, even the big oil companies want renewables exposure. Enbridge is investing in renewables. So long term, I want to have a piece of that pie too. And so owning Brookfield gives you that opportunity. Well, again, making you a huge amount of capital right away because they are a great compounder. They will continue to compound off of their other alternative investments. Remember, that's everything from bridges to skyscrapers. And on the side, you just happen to own a chunk of this really strong renewables business that is being managed by some of the best asset managers on earth. Their listed companies have compounded. In 2021, BN acquired its real estate affiliate Brookfield Property Group, which today represents a relatively small portion of BN's total capital, approximately 14%. Their investment in BPG was controversial at the time due to BPG's exposure to office real estate, which everybody has hated for 5 years. Think everything post 2020. Everybody's been like, man, we hate offices. And I think it's really interesting. If you're going to listen to somebody talk about office real estate or real estate in general, I would go check out the Canadian Real Estate Investors podcast. I've listened to those guys plenty. And they really do a good job of breaking down how office real estate is working right now. And to like summarize sort of the most recent stuff I've heard from them in like one sentence, basically, if you own the best stuff, you're good. You own anything else, you're hooped. You find a different use. Now, is that going to be true forever? Probably not. But return to office has not changed the game for these guys yet. We'll see over the super long term. But owning high quality stuff is big. And look at the next couple percentages. A disproportionate share of BPG's total value comes from a handful of iconic, high quality assets, including Brookfield Place and Manhattan West in New York City, Canary Wharf in London, and the Ala Moana Mall in Honolulu. So remember what I'm mentioning there. The best stuff is still making you money. It's still valuable. It's still good. You should still own it if you want exposure to office. And these guys don't just own, double A. This is like triple A stuff. I mean, Canary Wharf. If you've ever been to London, you know how iconic that is. Brookfield Place, Manhattan West in New York. I mean, think about one of the cities that has the highest quality office real estate on earth. New York City. These are some really high quality properties. If you ever see pictures of them, they look fantastic. I don't know about the mall in Honolulu, but I gotta assume any mall in Honolulu is probably killing it. Because, think about premium real estate. Hawaii is just about as premium as it gets. Amongst others, BPG's core portfolio occupancy remains strong. 95%. Lease terms are well structured, averaging 10 years, and same-store net operating income is growing at a healthy mid-single-digit rate, supported by robust leasing spreads. We anticipate funds from operations, FFO, will grow in the near term as BPG, the property group, benefits from growing NOI, deleveraging, and the positive impact of lower interest rates on floating rate debt. BPG also owns a large number of development assets amounting to $6 billion in equity in the aggregate, which generate immaterial cash flows today and are expected to be sold over time, simplifying BN's corporate balance sheet. Brookfield principally finances its real estate using non-recourse property-specific debt. Accordingly, there's minimal cross-collateralization across BPG's assets, which limits potential exposure to BN. During the past 2 years, BN has sold 192 real estate assets for $27 billion to third parties at an average premium of 3% to their carrying values. We believe that real estate as an asset class, and BPG specifically, has turned the corner. As falling interest rates, tightening credit spreads, improving liquidity, accelerating transaction activity, the trend away from work from home, and stabilizing cap rates have improved real estate's future outlook and led to a narrowing of expectations between buyers and sellers. As economic conditions continue to normalize and as investors become more constructive on real estate, we believe that BPG may prove to be another shrewd Brookfield investment. Then we have Brookfield Wealth Solutions. Just look at all these businesses. Each one of these makes sense as an investment opportunity. Owning them all and just being able to sit back, talk about sleep well at night, right? If you can, the last time we looked at Brookfield, we looked on a fairly recent, I think it was either 5 or 3 year basis. They were compounding 25% a year. But let's just say, for the sake of argument, we're talking mid-teens. You can sit on mid-teens compound annual growth of total return, sit on your hands and just live your life and have it completely diversified, operated by some of the best in the business, and own all these different businesses that each has huge potential. Wouldn't you want that? Wouldn't you want that in your portfolio? I'm not saying you got to make it 100%, but if Bill Ackman's willing to make it almost 20% of his, then I'm willing to pay attention. We'll go through Wealth Solutions here. This is a recent business. They talked about this at the front, but this is some of the recent stuff they've been investing in. In recent years, Brookfield has assembled a leading retirement and wealth solutions business, BWS, which I guess trades as BNT on the NASDAQ. Now manages approximately $120 billion of insurance float capital. BWS is focused on underwriting low-risk, long-duration annuities, which have become an increasingly important savings product for America's aging retirement population. And let me just say this, little inside baseball. The industry, as far as retirement planners, financial advisors at the banks, at the big insurance companies, love pushing annuities right now. It's a big thing. They love it. They love it. People I know that do that kind of work have been talking about it, where it's like this is the product that a lot of these big firms are really focusing on, especially at a time when maybe you're worried about the financial futures of a lot of these big retirement portfolios. Doesn't this sound nice? You're worried about sort of loan opportunities, right? How many people are willing to offer you a loan for a mortgage in Toronto right now? They'd probably rather not. So they've been pushing these annuities because they're really quite good for the business, and they offer some security for a retiree, which again, a lot of people want at times of uncertainty. BWS can be favorably compared to Apollo and KKR as symbiotic and highly successful relationships with Athene and Global Atlantic, respectively. Historically, insurance annuity companies would invest most of their assets in publicly traded investment-grade debt, an undifferentiated strategy which generated limited returns on equity. Over the past decade, Apollo transformed this industry by investing its insurance assets in privately originated investment-grade debt by building robust organic debt origination capabilities. Given the inherent leverages of insurance, higher return on assets drove substantial increases in returns on equity for these insurers, which has led to rapid and profitable growth. Legacy insurers are seeking to find their own differentiated source of improved asset returns and increasingly are outsourcing their investment management to Apollo and other private debt managers to remain competitive. While Brookfield is a later entrant to this industry and has a unique competitive advantage, Brookfield already owns $1 trillion of infrastructure, power, and real estate. These asset classes have financial characteristics that are uniquely suited for insurance, which include their long-term contracted cash flows and inflation indexation. Brookfield is also a massive insurer of investment-grade debt, of investment-grade debt to the capital markets. Over time, Brookfield intends to invest a portion of BWS's investment portfolio in Brookfield-related assets, including investment-grade debt to a smaller degree in the equity of Brookfield-owned assets or funds. So what they're saying right there, basically, over the last little while, even with interest rates the way they are, asset managers who run these big insurance funds have been looking for something special. What is the secret sauce where we can generate more returns on this capital because they have a set payout, right? So imagine if you're thinking like cost versus profit. The annuity, you pay upfront and you have a set amount coming to you. So those companies know exactly what their cost is over time. But if they can outperform the market using the structure of an annuity, which does have its restrictions, and of course, without being foolish and risky, they're going to do it. And think about what Brookfield brings. Obviously, they own a huge amount of assets, and so they have the potential to bring to that business some serious outperformance in contrast with some of their peers. And so I could see that business growing really fast. And the insurance business, while it might not be flashy, is really strong long term. These big insurance companies have killed it in the long run. All right, we're going to carry on here. While detractors have recently taken issue with these related party transactions, we arrive at a different conclusion. We believe the ability for Brookfield to selectively invest its insurance investment portfolio in assets it already owns and knows intimately well is a unique competitive synergy with strong financial logic. It allows Brookfield to earn higher returns on equity while policyholders benefit from investments in lower risk product, giving Brookfield's informational edge in equity ownership of the underlying assets. Notably, such related party transactions are subject to third-party valuation assessments, as well as regulatory oversight and approvals. So they're not just going to cheat, is what this is saying. Brookfield can't just be like, all right, so we're buying our assets and that's how we've covered you, and these assets are worth a huge amount and now we're super rich. There is a lot of oversight, but still, they understand the assets better than anyone. And so if they are running the insurance wing, offering these annuities, the financial sort of management wing can look at, let's say, the assets they own and say, hey, you guys know what this is worth, like intimately. You've known what it's worth the entire time it's been there. You've owned this product. You own this asset. What is it return? What is it worth? And can we, loan you it or use it as collateral or in some way use this to have an outsized outperformance? Their insurance annuity business is synergistic for Brookfield, as BAM invests the insurance float on behalf of policyholders, generating a capital light and high margin management fee stream to BAM, while BN, remember this, the company we are really interested in, realizes earnings on realized asset yields above the cost of the insurance company's liabilities, which is the spread earnings. So whatever that cost is, right? Again, set annuity payout. what is your return? If you beat that annuity payout, well, essentially, that's going to BN, which is great. BN is currently generating a low to mid-teens return on equity. And I like that. Again, you beat the market by 1 or 2% a year consistently, and you kill it long term. This is exactly what they're aiming for here. The earnings are poised to expand over the near term as Brookfield repositions an acquired held-to-maturity asset portfolio inherited through BN's American Equity Life acquisition. BN anticipates accelerating organic origination capabilities over the near term and intends to more than double insurance float to $300 billion by 2029, driving significant increases in cash flows to BN and fee revenue to BAM. Brookfield Wealth Solutions is likely to remain a meaningful growth asset for Brookfield as the overall market for these products is growing at an attractive rate, and the market is consolidating assets with best-in-class managers. We believe Brookfield has a unique right to win in this marketplace. I think that's a huge win, really. We've talked about this a couple times, but just having that money come in, that huge cash flow up front for a company like this that then can leverage that to buy the next building or whatever, build the next asset, build the next bridge, build the next pipeline, buy the next thing. You know, in a world that needs these big infrastructure assets to be bought by third parties, or at least have these third parties involved where they can generate huge returns, and owning the parent of that, where you're not even throwing all your eggs in with the wealth management. Maybe you don't like the insurance business. Well, you've got so many more businesses attached that can just help you win. Let's talk through the summary here. Including its proportional ownership BN, Brookfield generated $5.3 billion of DE distributable earnings in 2024, with minimal contribution from carried interest. On a pro forma basis, using Wealth Solutions' structural earnings power and normalizing for our estimate of BN's steady state carried interest, we estimate BN's DE are approximately $8 billion. Including our expectations for organic growth, we estimate recurring cash flows will roughly double through 2029 from the current levels to more than $10 billion, a mid to high teens compound annual growth rate. Growth will be driven by the growth of Wealth Solutions, AUM, large increase in contribution from carried interest, teens plus growth in BAM's fee-related earnings, and a stable mid-single-digit growth across Brookfield's other holdings. Our estimates are conservative compared with BN's own long-term targets of almost $14 billion by 2029. The combination of recurring cash flows, carried interest realizations, and capital returns from BN's direct investments and asset sales from BPG, we expect BN to generate more than $45 billion in cash flows over the next 5 years. After considering the capital required to fund Wealth Solutions' growth objectives and other investments, this leaves more than $30 billion in excess cash flows for BN, more than 1/3 of their market cap, which can be deployed for intelligent capital allocation or share repurchases. Presently, Brookfield Corporation has a market capitalization of $80 billion. BN's ownership in its publicly listed affiliates nearly explains this entire market cap. Their ownership of BAM, BEP, BIP, and BBU collectively sum to $71 billion of market value at BN's proportionate share. In other words, the current share price and investors paying $9 billion for the combination of Wealth Solutions, BPG, carried interest, and $11 billion of direct investments BN has in BAM's private funds. We estimate that BN is trading at a 40% discount to a sum of its parts valuation. Think about that. If you're buying this at a 40% discount, if you're a value investor, you just lit up. Fantastic. I think anytime you hear someone as well respected, as knowledgeable, as big as Bill Ackman say, hey, 40% discount, you should pay attention. Their valuation based on future cash flows, they're saying it's trading at 12.5 times our assessment of next 12 months DE, or 10 times adjusted for increased earnings from BWS and our assessment of steady state carried interest. Considering the composition of BN's future cash flows and using a weighted average multiple, we anticipate Brookfield should generate 25% plus compounded returns for shareholders, assuming a conservative assumptions on an exit multiple for the business. We apply to 16 to 17 times multiple BN's 2029 economic earnings, principally driven by high 20s multiple of earnings from BAM, mid to high teens multiple of the cash flows associated with affiliate distributions, 10 times multiple on our estimate of normalized carrying interest, and 10 times multiple on the distributable earnings from Wealth Solutions. While the composition of BN's future cash flows will remain diversified, a disproportionate share will come from BAM given its relative higher valuation. Comparison to public traded peers suggests further valuation upside. Most relevant company comparables include KKR and Apollo, which trade at 21 and 16 times respectively. KKR is more comparable to BN, as it has a similar composition of cash flows, diversified across FRE, carried interest, spread earnings, and expects it to expand its direct holdings of operating companies. Apollo generates approximately 2/3 of its distributable earnings from Athene spread-related earnings. A lower quality earnings stream would suggest that 16 times D should be the floor valuation. Remember, right now, if they're saying 16 should be the floor, and yet right now it's, depending on if you count the things they're expecting to happen, it's either 12 or 10. So you're talking we need at least 4 times. As a Canadian domiciled company, Brookfield has largely been ignored by many U.S. institutional investors. We anticipate that improved investor relations and sell-side analyst engagement by BN should help increase ownership of BN across U.S. institutional investors, which should help close the valuation discount, which the company is taking advantage of through large share repurchase. So we see the public company engagement here. And I guess that is the end of what Bill Ackman himself has to say to us. Now, I think it's really valuable that we read through in detail when we see these super investors invest alongside us. Remember, this is one of the most respected investors on earth who directly wrote for us a whole article talking about a company that here on the channel we have owned for a while. This is one of those companies. Yes, it's political now, I know, but for years it has been ignored. It has been sort of left to the side, away from the spotlight given to the big banks, and yet it is incredibly profitable. It is a great compounder, and it has returned a huge amount of value to shareholders. Total returns look great, and I think if you are looking to diversify your portfolio like I am, if you're somebody who already owns maybe energy, you own some US stocks, you already do own some banks, this is a great way to get a lot of the other things. Remember, a big chunk of this is their alternative investments. How else are you going to invest in pipelines, bridges, highways, railroads, and all of these other assets that, are you going to build them? Am I going to build? No. But we get this giant, diversified, incredibly profitable company. And we're getting it at a 40% discount, according to one of the most famous investors ever. Honestly, it's really exciting when you see news like this come out. When you see big guys like this continuing to invest alongside you. And I think as Canadian investors, we should take advantage. This makes a lot of sense in a lot of portfolios. And I know it makes sense for me. And Bill Ackman thinks it probably makes sense for the rest of us. So let me know what your thoughts are. And I want to say this again. I know this is a politicized company now that Mark Carney is the prime minister. I almost said president. That'd be funny. But please, let's just talk about the company here. We don't need to talk about the politics. What do you think about the company? Do you think he's right? Do you think he's wrong? Is there a specific subsidiary you'd rather own? That'd be an interesting conversation, right? It depends on what you're using this investment for or what specific parts of it you're most bullish on. Really love to hear your thoughts in the comments down below. And with that being said, I hope you enjoyed the video. If you made it this far, please do like the video, subscribe to the channel, and I will see you in the next one.